Welcome to the OxIgnite Podcast hosted by Yusuf, Raza, and Michael Hutson, two entrepreneurial MBA students at the University of Oxford. Together, we navigate the dynamic journeys of Oxford-linked founders, venture capitalists, and trailblazing innovators. Our mission, to fuel the fire in Oxford's next generation of boundary-pushing change makers. Today, we're joined by Mathias Pastor, the co-founder of Semper. Semper provides liquidity for iconic teams and runs recurring, end-to-end secondary transactions for the teams of fast-growing startups. By making the value of equity more tangible, Semper helps its partners attract and retain the best talent. In this episode, Mathias draws on his early entrepreneurship experience, his many years at the family, Europe's largest early-stage accelerator program, and his experience building Semper to share his lessons learned from previous ventures and his observations on the common characteristics of successful startups, as well as what leads to most startups failing. Mathias also introduces us to the world of secondary transactions at high-growth startups and the current inefficiencies that Semper is addressing. Listen on to learn more about how Semper uses liquidity to align the interests of private companies, team members, and investors. Get ready, get set, get OxIgnited.
Congratulations on being guest number one. So this podcast is basically meant to highlight different people in the entrepreneurship ecosystem who are affiliated to Oxford in some way. And I'll be interviewing a lot of great founders, investors, and so on, to just learn more about their own personal life story that's led them to where they are currently right now, and also learn a bit more about what they're doing. So today we have Mathias Pastor from Semper. Semper helps forward-looking companies attract and retain builders by giving them real ownership of the value that they create. Mathias, could you just expand a bit more on this?
Yeah, thanks. Well, thanks so much for having me, Yusuf, and congrats on launching the podcast. I'm excited to learn what you end up calling it, and it's cool to have an opportunity to go back to the Oxford days. In terms of Semper and what we mean by helping builders really benefit from the value they help create, what that means is we've seen a new trend kind of over the past 10 to 15 years of companies increasingly giving out equity to their employees as a way to incentivize them both to stay for a while and to work hard whilst they're there. The problem is that trend of giving out more equity to employees has happened at a time where companies have also decided to stay private longer and longer. Now when you look at the age of the average company that goes public, it's often somewhere between 12 and 15 years. And that just, we think, creates a bit of a mismatch because the people who join the companies don't necessarily want to wait 12 to 15 years to be able to sell their shares and do things in the real world with the value of their equity. And we think that because of that, some of these great growth companies aren't hiring the best people or some of the people that they could be hiring if they were more competitive, versus a Meta or a Google or an Amazon. And so my co-founder Balthazar and I decided to essentially build the infrastructure and the market for private, fast-growing companies to make the equity part of their compensation as attractive as that of publicly traded companies, essentially.
Right, understood. Thanks for the introduction. So we're going to jump into further details about Semper later in this podcast, so stay tuned for that. But first, Matthias, I want to rewind the clock back a little bit. Can you sort of tell me a bit more about your what's your life story growing up, and tell me a bit more about your time at Oxford as well, and how do you think that's shaped you to sort of be in the entrepreneurial ecosystem for the next, it's been suppose 10, almost a decade for you now within this entrepreneurship ecosystem, right?
Yeah, I mean, so I've had I've been very lucky kind of throughout. I was born in France. My parents moved quite a bit when I was a child. So we got to spend quite a lot of time in the US, which is why I hope I don't sound too French when I speak. And I was lucky enough when they settled back fully in France to study in an international school where there were people kind of from all over the world. And for the most part, those people intended on studying abroad, which was not something that I'd ever really considered, or anyone in my family had ever considered, because I'm the eldest brother, and so
Hmm.
um, I think that was kind of setting a new trend within the family. And I can't claim, a huge amount of credit in deciding that I was going to do that. I think one of my best friends at the time was very determined to go to Oxford because he was British, and that was kind of like the pinnacle of academic achievement. And I was determined to go to the UK, and I guess I was a bit competitive, and so I decided, you know what, I'm going to do something similar. Um, and so it ultimately ended up studying philosophy, politics, and economics at Wadham College um, between 2015 2018, which was great. Um, I'd actually started a company right before joining Oxford, which was a education company, a peer-to-peer tutoring company, and I think that was one of the tougher things. Was honestly juggling having this company for which we'd raised a bit of angel money, like pre-seed money, at the time as a very young founder, um, and at the same time trying to study and be a student at Oxford. I think the attitude to entrepreneurship has changed a lot in the school from what I've seen compared to when I was there in 2015, 2016. Um, and slowly the university has kind of embraced the idea that their students might want to be entrepreneurs when they leave, but also potentially, start building things when they were there. And we can go into more detail, but at the time, it wasn't, at least some of the people that I encountered weren't necessarily the
Hmm.
most supportive of my entrepreneurial endeavors whilst I was a student. Um, but yeah, no, I loved my time at Oxford. Met a lot of friends that I hope I'll keep for life. Had a lot of fun studying philosophy and economics. So I'm very very happy that I spent a couple of years there.
Think of like just to clarify, is the education company Teach App, or was that
Yeah,
another venture that you? Okay, so this was Teach App. So
exactly.
uh, I mean, like I've also been there, starting a company at a very young age, and you, you learn, you make a lot of mistakes, but you also learn quite a lot while doing that. What do you think you could have done differently when it came to that particular, like your first baby, if you want to call it?
So many things. Um, so many things. I mean, there were a lot of things, where I kind of felt, well, where I now kind of feel, looking back, that we were, playing grown-ups in hiring more people than we needed just because we could, in, you know, trying to implement processes that we'd read were useful but didn't necessarily make sense given the stage of company that we were at.
Mm.
And then on the more specific stuff, I think we got a bit lost. Initially the product that we were building had some appeal because we were building something that we wanted ourselves, and so it's a pretty easy thing to follow. Like the initial observation was just, um, there's a supply of people who are decent at school, and there's a demand of people who aren't that good and need help, and everybody's looking to make a bit of money as a student. So we just thought, we have this kind of supply of university undergrads that could be kind of on-demand tutors for middle school and high school people.
Mm.
What we'd underestimated was just that it would take some time. It would take some time to educate parents about the fact that this was something that they could be comfortable with,
Mm.
um, and we also underestimated how much customer support you need to do when it's to parents that you're selling. So we started off selling directly to students, and it was essentially like $5 and you get your homework done, which was great. but didn't scale super well. And then when we started doing things where the parents were involved, I had my personal phone number on the website, and I just get like random moms calling me on Sunday evenings being like, oh, my kid Joe got like a C minus and we've spent like 30 pounds on your service already. Like you're not doing a good job, whatever. And, at that point we had thousands of students who were using it. I had no idea who Joe was. So it was, yeah, I think there were a lot of things that we would do differently. The main thing is just spend more time understanding whether or not there was an actual market for this. And going for markets where the feedback loop is slower. I think we had early success because we launched an exam period. And so we had the impression that people cared about this a lot more than they actually did. And so it was great for like April, May, June, where people were kind of stressed and ready to do anything to get their exams done. But the rest of the year, it was really quiet. And the problem when it's seasonal is that you don't necessarily know if it's because it's seasonal or if it's because what you're doing just doesn't really work. In our case, it was a bit of a combination of both.
Understood. It's kind of like interesting though how years later now you're doing a marketplace again, albeit of a different kind. So it's
Yeah,
a bit.
maybe I didn't learn enough from the first time.
So here's a question I have out of curiosity. Right? While I was while I was like inviting people for the podcast, I saw that there were quite a few people who did PPE at Oxford and went on to become entrepreneurs. It's kind of interesting because I come from more of an Asian background, where normally the route here is tech. If you're becoming an entrepreneur, you think more about you're going to study engineering or you're going to do IT or computer science. I think it's because you've got the famous Indian computer scientists or so on who've gone on and become really big as startup entrepreneurs, right? And how I think it could be interesting to understand how do you think studying philosophy specifically has kind of like helped shape your thinking patterns as to how you go about some of the decisions you make as an entrepreneur.
Sure. So I'd say I think it's much more useful overall to study engineering
Okay.
of any kind than to study philosophy or economics to be an entrepreneur. I think the reason that you have this is more of a selection bias thing. The UK, in France, for example, where I'm originally from, I'd say most of the people who end up becoming founders either study engineering, or there's some kind of prestigious more business school types, but nobody definitely studies philosophy. I think that the UK is just a bit odd, is a bit of an anomaly globally in the prestige that it attaches to random topics like classics or philosophy and things like that. And so I think when you're a bit lost as a 16, 17-year-old and you need to decide on what you're going to do, you kind of look for what's externally validated and what other people tell you is good. And so you end up studying things like philosophy.
Yeah.
So I think it's definitely more that way around than the other. It's just those topics being prestigious attract competitive people, and people, I think there is an element of competition if you want to be a founder, like you want to create stuff, but you also want to compete on one of the hardest stages possible.
Yep.
And then in terms of like, honestly, I think the main thing that philosophy has given me, and specifically philosophy at Oxford, to be honest, that's helping me. I don't know if it's necessarily as a founder, but just in my work, is that it's the most brutal experience I've had in terms of my writing getting destroyed. So, the experience when you're studying philosophy at Oxford is every week you write an essay, and every other week you're defending that essay against the tutor and the other student in your tutorial. And then you do that on the odd weeks, and then on the even weeks, you're attacking the other student's essay alongside the tutor. And so that means that every week, something that you spent an entire week writing will get back to you with loads of red line of, this is useless, this doesn't make sense, why are you trying to be pompous? And so over time, you're I do think it does make your writing much better. Like I came into Oxford thinking that long essays with lots of complicated words was the best way to show how clever I was.
Mm-hmm.
And I came out with a love of, 6-word sentences, and trying to be as precise as possible, which is really useful because, when you're building a company, and in particular in contexts like the ones we've had over the past couple of years where a lot of the team is remote,
Mm-hmm.
uh, if you don't write clearly, you spend so much time. I mean, you end up losing so much time on trivial things. So I think that's definitely the biggest gift I got out of it, and potentially something that you get a bit less of as an engineer. So I'd have to say that clear communication might be my only comparative advantage from in terms of what I studied.
Yeah, but I think like communication is kind of like underrated, right? You mentioned it from a team aspect, but then when you're looking at everything, such as like speaking with investors, speaking with potential customers, how that translates over into your marketing materials, especially if you're doing something with a very complex product, how can you kind of like make that simplify that for anyone to understand the value proposition more easily? I mean, like I think those are pretty portable skills based on the way you kind of like put it. um, I know you spent a lot of years at the family, which is one of, I believe it's Europe's biggest accelerator, or is it? Or it's kind of, I'm not sure about that. Maybe you can expand further on that. But you spent 4 months working at a hedge fund. Um, what kind of like led you down that path, and why did you decide to leave that and then go into the world of early stage startups on the other side?
So I I started this company in education that we talked about earlier called Teach. That was really tiring,
Yeah.
and not incredibly lucrative, to be completely transparent. I spent a lot of time
Mhm.
at that point. Um, we were essentially not paying ourselves, all the money that we'd raised, we were using to hire engineers, run Facebook ads, whatever. And I spent 2 years doing that and didn't have any money coming out of it.
Mhm.
Um, and had was working crazy hours because I was doing that alongside the degree. And so when we decided that we were going to move on from it, I didn't really know what I wanted to do. I think that you don't really do these things with a big plan B in mind. And so I was like, okay, what do I do now? And I'd been in the habit of working alongside my studies, so I didn't just see myself going back to being a full-time student. And so um, I wanted to do something over the summer, and so I typed best paid job UK on Google, and I ended up on one of those listicles from a website called eFinancial News Careers or something, that said the top 10 hedge funds in the UK or something. I didn't know what a hedge fund was at the time, but I just wrote a cover letter that was tailored to the first one on that list, and sent that to the 10 10 companies listed on the thing. And of course, 9 of them didn't reply, but one of them did. And I had a really fun interview process with a firm called D Shaw. That's initially a New York-based hedge fund, but that has a small team, relatively small team in London. And they sent me to New York to be interviewed, and then I interviewed in London, and ultimately ended up working there as an intern for a couple months. And it was great. I mean, the learning curve, you know, I was a philosophy student that was okay at math, but by no means, I was the other 3 guys working there, like on the same summer program as me. There was one guy who was a math master's at Cambridge, one guy who was just finishing a statistics PhD at Harvard, and somebody who'd done mechanical engineering at Oxford. So I was definitely by far, the only, the least mathematically able person on that group, but which also meant that the learning curve was steepest for me. And so I had a really fun time for those 4 months. Um, the pay was great, and ultimately they wanted me to stay longer. Um, and the main reason I didn't do that was just that I felt like after 4 months, the learning curve had started to flatten a bit. Like I was obviously still learning a lot because I'd only been there for 4 months, but projecting like 4 years out, it didn't feel like I was going to learn anywhere near as fast as I'd learned over the past couple of years. And then the other thing was just that at that point in my life, I think I was still in a bit of a building mindset, and I thought it was really fun to be around people who were building things. And it's incredibly intellectually stimulating to be working in a hedge fund, but you still feel, well, I had the impression that I was still very far from the real world. Like the things that I was looking at just didn't really have anything to do with the day-to-day life of the people around me. And, I met people from the family and ultimately decided to work there.
All right. Thanks for the backstory there. So you ended up spending, I believe, around 6 odd years then with the family, right? So you would have seen a lot of early stage startups come and go, a lot of success stories. Of course, with startups, there are more kind of like stories that aren't that successful compared to the ones which are successful. Unfortunately, I think like we end up seeing more of the successful stories in the news. So people kind of like attune their expectations towards that, which kind of like believe puts some unrealistic expectations, which founders always try to align themselves to, and kind of like, I don't know, I think that's kind of like responsible for some elements of founder stress that kind of like is. But I think what I want to ask you is, are there any particular common characteristics that you've seen for companies that came out from the program and ended up being very successful? And conversely, did you see any traits that were kind of like common to startups that didn't really work out? Could be the team, could be the company or the product itself, could be, different aspects.
Yeah, I mean, there's a lot to discuss there. So at the family, we're definitely seeing a lot more failures than successes, and that was inherent to the model. Our goal was to work with about 100 new companies every year, and we would consider that we'd had an incredibly successful year if out of those 100, something like 10 to 12 ended up raising a Series A. So that means, we were saying that success was a 90% death rate. Which is emotionally quite stressful because you do spend a lot of time and emotional energy with the founders who ultimately end up doing something else, which is completely fine. I think it's hard to distill it, but the common traits were, one, bias for action. Like there was a stark difference between the people who would come back to us every week and had tried the things that we'd discussed during our office hours that weren't necessarily like, we don't have a crystal ball. They don't have a crystal ball, but until they've tried, nobody will know. Versus, the kind of more philosopher types that would ponder for weeks whether or not it was the right thing to do. Like at the beginning, no one really cares what you're doing. So like the cost of changing things is pretty much zero. But the cost of not changing things is really high until you've found a meaningful product market fit. So people who had that bias for action and were ready to try things really quick overall progressed much, much faster. And then the other thing was, if you look at the biggest success stories from the family, we've had some, incredible stories, like in the 500 million plus outcome range. But all of those, and really all of those that had outcomes that were like north of 100 million, I'd say the common characteristic was that they weren't trying to invent a market. They were really well positioned for a wave that was coming up. And in most cases, they're actually in industries where there's quite a bit of fragmentation, but the spaces are so big that there's actually a lot of big businesses to be built there. And I think that's a common characteristic of founders, and especially young founders, where you have the impression that the market is a lot more crowded than you think it is, because you don't realize that, the world is pretty big. And if you're building a service that, can be sold to any SMB or any mid-market company or any, middle-class consumer,
Mhm.
it's not because there's one, two, three venture-backed companies already doing that you can't have a big outcome in that space. Especially in Europe where you have fragmentation, like borders do prevent products from traveling, even from a marketing and kind of brand recognition standpoint. So, um, and maybe that's why we don't yet have a company that's a 50 billion plus outcome, because we
Mhm.
don't have any of those that actually created the market. Like we had a company that was doing something somewhat like Uber, um, and that's one of the leaders in France and in a lot of places in Africa. Um, they're valued somewhere like 250 million. We have a company that's a payroll software, kind of like Rippling or Gusto. They're valued about 2 billion, but that's still a bit lower than the 10 billion that the Americans are valued at. We have a company, yeah, so we have several of those, but they were just in markets that are so big that even if they're not the number one, they can end up being really big outcomes. And um, yeah, on your point about people overestimating the successes, I think in a way it's good for society that we're in that situation. Like even though it does create some of the stress, if you speak to a lot of the founders, whether they succeed or not, they tell you, if I known how hard it was, I'm not sure I'd do it again.
Mhm.
But we're all better off for the products and the businesses that they've built. So it's kind of good that everybody thinks they're different. So I saw this tweet a couple of weeks ago of a guy who said like something about a plane crash
Mhm.
and being convinced that he would have found a way to survive. And I do feel like a lot of founders are kind of in that mindset where they have the impression that they would be the one person that survives the plane crash.
Mhm.
Uh, and it's that kind of incredible faith in yourself that you need, because the highs are high, but there's few of them, especially at the beginning, and the
Mhm.
lows are really low, and they're only for you. Like nobody cares about the lows as much as you do. And so if you don't have that faith that, the plane might crash, but that you'll survive ultimately, I think it's a really, really tough job to pick.
It's kind of like it's quite the adrenaline rush, though. I mean, those early highs and that come.
100%. And they get you through, all of the lows that follow.
Yeah, I think like at my own experience, I tried doing another venture around the end of last year or so, and then I found that as a repeat founder, I was kind of cynical in a lot of situations, and that bias for action bit where earlier the first time I was doing a startup, it was you don't think, you just go and do it because you're convinced you're going to do something right, and then if that doesn't work out, you go the second time, you're still convinced that okay, this time you're going to crack it. I found that the second time I was a bit more cynical and kind of like slower to take action or so. Maybe that's one of the reasons why that particular venture didn't really work out or so. But I think those were some really good points that you brought up around startups that ended up being successful versus the ones that didn't. So before we get into Semper, I know you and your co-founder worked together for quite a few years at the family. In terms of your working relationship, uh, was this a case where like you in some cases you have relationships with people where, or with your work colleagues, where you always like you're going to start something together down the line, and then you're just kind of like waiting for the right idea to come along, or was this a case where you realized the opportunity and then you decided, hey, let's work together on this?
Um, it's a bit of a mix. So actually, the story there is that we realized whilst we were at the family that this liquidity for employees was going to be an issue, because some of the more successful companies that we'd backed came to us saying like, hey, I have my ex chief product officer that wants to sell 500K worth of shares. Can you help me find a buyer for them? And so we did that for them in a kind of manual ad hoc basis. And then once we did it one times, three times, two times, three times, realized, well, you know what? All the companies that reach this kind of stage are going to need it. And so Balthazar, my co-founder, was like, we need to build a dedicated kind of spin-off to do this.
Mm.
And And then as we were, interviewing people to potentially lead that spinoff, kind of understanding what the market was like, he realized actually this is the business that I want to build. So I'm going to go out and build that spinoff. And at that point, I'd already decided that I was leaving the family and going to build my own thing. At the time I was thinking of building a fund of micro funds.
Mhm.
And after a couple weeks of working on the months maybe of working on the fund of micro funds thing, realized that's not what I wanted to do, and then caught up with Balthazar, who'd started working on what was going to become Semper, and he was like, if you want to help me on the go-to-market side of things for a couple months whilst you're figuring out what you want to do, like you can do that. And that's how I joined initially, thinking I was going to spend 2 to 3 months helping him get the first couple customers on the company side, and ultimately I ended up staying, and it's almost been 2 years now.
Got it. I think because both of you would have had the investor relations from your time at the family, I guess when it comes to building up the marketplace, you already had those investor contacts and you started off focusing more on getting companies involved, right?
So the difference that we had between the family and what we do now is that at the family we were focusing on the earliest stage companies. So typically, it was companies that were looking to raise anywhere between 100K and €1 million, but the companies themselves were worth anywhere between 3 and 10 million euros. And so we were really looking for those kind of early stage investors that were really willing to make high risk investments in relatively small amounts. Now, what we do is that we work on transactions that are typically between $5 and $20 million, but they're in companies that are worth anywhere between 500 million and $5 billion. And so the risk profile of those investments has changed a lot. The businesses are much more mature. And so the type of investor that we work with also changed quite a bit. So before it was more early stage funds and business angels, and now it's more family offices, hedge funds, secondary specialists, funds of funds, those kinds of people. And then the other thing is that, we decided to start with companies because most marketplaces tend to be supply driven. So, you can spend time acquiring riders if you're Uber, but if you don't have any drivers, it's not going to be a very good experience for them. And it's kind of the same thing for us. Like, we could have spent time building up the investor base, but if we didn't have any company that we were going to work with, then what were those investors going to look, what opportunities were they going to look at? And so we decided to go for what we thought the real bottleneck was, which was supply. And then, then it's always a balancing act. You're growing the supply and trying to make sure the demand keeps up. And then, going back to spending more time on the supply, et cetera, et cetera.
Got it. So you mentioned that you were doing a lot of this process manually while you were helping out the family's companies that went big, right? What were who are usually the stakeholders involved in such transactions? And when it comes to the status quo or how things were at that point, what were the inefficiencies that you identified that you're now trying to address with Semper?
So there's quite a few stakeholders. The main stakeholder is the shareholding employee. So, you as an employee at Stripe get a grant of options or RSUs or whatever, some kind of equity instrument that vests over a certain amount of time, and then you want to be able to sell them. So that's like our key stakeholder is the person who owns the equity. But to get to that person, we first need the company's approval. And so there, typically at the company level, the stakeholders will be the CFO and the general counsel, so the person who takes care of legal topics. And then usually there needs to be some kind of buy-in from the CEO or the founders. So like they need to be agreeing in principle that this is going to happen, but they're not the people who are operationally involved in getting it set up. That's really more the CFO and the general counsel. And then in terms of how it's usually done, so typically, so these transactions where employees or existing shareholders sell their shares is known as secondaries, and typically secondaries happen bundled with primary fundraisers. So when the company raises money, usually when you reach a certain stage, what will happen is you're raising $100 million at a 500 million valuation. What's actually going to happen is that of that 100, there's going to be 90 that's primary money, so money that's going into the company's bank accounts, and there's going to be something like 10 million that goes to buy back the shares from the founder and early investors and early employees, that kind of thing. And so that's how it's typically done. And then the actual execution of it is done by lawyers and paralegals who spend time, handling the contracts and the wires and everything. So the first thing was, okay, all that legal work could actually just be done by product. You don't need lawyers and paralegals doing it. It's super expensive for not much added value. So we can do that. And the lawyers are typically quite happy because it's not the most interesting work, to be honest. So they're happy for our product to do that. But the second observation was, the only reason that it's bundled is because that's the only efficient way to do it. But if we could tell the company, listen, we're going to run one of these every 6 months, then it wouldn't necessarily need to be bundled. And so you could have secondary transactions that happen every 6 months so that you as an employee have visibility over when you're going to be able to sell your equity. That's not dependent on when the company is going to go out and fundraise.
Got it. And you mentioned these are recurring. You set it up in a way that it's recurring, right? I mean, like, where did you get the idea for that, and how is the response to that been?
Yeah, so we try to push for it to be as recurring as possible. Depending on the maturity of the company, it'll range anywhere from once a year to 3 to 4 times a year. And the main reason there is just that if you want to make equity tangible for people, you need to give them visibility on when they're going to be able to sell. Because, if you're an employee at a public company, typically your stock vests every month. And as soon as it's vested, you can just decide to sell it from your brokerage account. So, whether you keep it or not tends to be a tax question. But if you want cash, you can sell it for cash. And so if as a private company, you can make the commitment that you are going to run these transactions on a recurring basis, then that's a huge added value for your compensation strategy compared to other private companies that typically don't. So the reception there has been pretty good. What's been tough in this market is that there's been a lot of volatility around price. Like in 2021, we saw really, really high valuations, very, very high multiples. A lot of companies were clever and raised when the terms were very favorable to them. But now the market isn't as welcoming of high growth, high burn companies. And so their price has corrected quite a bit. But there's still some hesitation from the companies about materializing that new price. So, they're like, we know that if we went out and raised now, we would be worth half or a third of what we were worth a year and a half ago. But they kind of bury their heads in the sand and they say, if we don't do it now, then it's not for real, kind of thing. And so that's been the tougher thing for recurrence in this market, is just that people don't really know how to navigate price.
Let's dive a bit deeper into that. How does the pricing get set in such a scenario? Or rather, can you just walk me through the end to end? Suppose there's a company that you work with, right? How does the whole process work where you're helping them do this kind of finance, let's say?
Yeah, so that's
where you help them.
so the price question is a really good question, and it's something on which we've iterated quite a bit. I don't know if we have the final solution yet, but we have a good something that works. So the way that we currently do it is we give the company an initial assessment of where we think the valuation is likely to land. And this is kind of resembles what an investment bank would do when they're preparing an IPO or some kind of M&A process. So you go to the company and you say, okay, I think we can reasonably expect a price within this range. And then,
Mhm.
if the company is open to the idea that it lands there, you kind of progress to step two. And step two is you go to a small set of investors that you trust and you think are representative of the market and you can get quick feedback from. And you say, okay, this is how the company is doing. This is their story. This is what they're trying to achieve. Where would you price it? And you kind of check that the price that you gave the company initially matches the market's current expectations. And you go back to the company and you say, okay, we spoke to 15 people, 10 of them give a price, and the price they give is within this range. And then you say again, like, okay, are you ready to go to the next step? And then the final step is a step that essentially resembles a kind of more open auction. So we go to all the investors that we work with and we say, okay, we're working with this company. This is how they're doing. We'll organize a call with the management. We'll set up a data room for you to review, et cetera, et cetera. What kind of amounts would you be interested in investing and at what valuation? And then we go back to the company with all those lists of offers and we say, okay, there's Yusuf who's ready to pay this price, Mathias is ready to pay this price for this kind of quantity. And then the company essentially picks who they want. So the price is set by the market, but with the control of the company. And so if they decide that none of the prices are good enough, then they can just kind of call off the transaction.
All right. And then basically what you're enabling here is that you're letting the company choose who the investors would be who would be buying back those shares from the employees.
Exactly.
So it's kind of like the process is running more in the hands of the company as opposed to, I'm not familiar with the exact names, but I know there are some kind of like marketplaces that claim to allow employees to sell secondaries. And I don't know how gray of an area that is, but the way you're doing it is fully with the support of the company.
Exactly.
Right?
Yeah. So we have a really company-centric approach. We think the companies stay private for a reason, and one of those reasons is picking who their shareholders are going to be. And so we don't want to go against that.
Trend coming along where you've got people coming together as syndicates and investing in earlier stage companies, right? Do you think, because I'm not familiar with late stage investments, do you think there could be a trend towards that as well in Semper's situation where you might have people pooling in the money to then buy, like a piece of a larger company?
So that already exists to some extent. It's a bit harder because it's if you look at the syndicates, typically they're in the sort of 100K to like 500K range, and sometimes the more successful ones will do single digit millions in aggregate. And then if you look at the individual number of people, they're typically investing 10 to 25K or 5 to 25K. And so that's relatively easy when you're doing 500K to a million because it's or 100K to a million because it's somewhere 4 and 40 people. But if you're working on the transaction sizes that we want to work on, which is, for now it's 5 to 20, but hopefully we'll be able to do 10 to 50, then that means you need to 10x again the number of people who participate. And so it just doesn't necessarily become the most convenient way to do it. And I feel like even when you do look at the most successful syndicates, most of them end up raising funds because it's just so tiring to do deal by deal transactions. Like, if you're a syndicate lead, you're in this very uncomfortable position where you don't have full visibility on the interest that your community is going to have. And so when you're negotiating with the founder, you say like, oh, give me 100K allocation, but you don't necessarily know that your community is actually going to come up with the 100K to invest in that opportunity. And so if you don't, it can kind of hurt your reputation amongst founders who are looking to raise. And so over time, I feel like a lot of the more successful syndicate people end up trying to raise their funds so that they have this more committed source of capital. And I think that we're definitely going to see emerge. And even just in the past 6 to 9 months, there's been a few kind of secondaries dedicated funds that have been raised in Europe to seize those opportunities. And so I think that's going to be, that's going to become more and more frequent.
Got it. The vision's really nice and grand, but what have been some of the key challenges for you? I think what I can understand is because you've got three different stakeholders, education is a big piece of you trying to achieve where you want to go, right?
100%. We, I said earlier, the most successful businesses that we saw the family were people who weren't trying to invent a market. And we obviously being that person on the plane who thinks that he's going to be able to survive, decided that we were going to go towards more of a market invention thing. There's definitely a lot of education that needs to happen because all three stakeholders aren't used to this. The companies, there's no like established benchmark on how to run secondaries in a structured way. So we need to give them a setup. The employees, for now, outside of Silicon Valley, they've essentially discounted the value of their equity almost to zero. And so we need to convince them that it's not worth zero because we need them to really want to have this in place or else the company is not going to do it. And then the investors, for a while, it's starting to change because you're starting to have sophisticated investors that are changing their approach on this. But for a while, secondaries was less noble than primaries. And so we've kind of had to redeem secondaries colors in the eyes of investors. And so there's the three different stakeholders all need to be educated about what we're doing. Absolutely. It's a huge part of what we do. Like there's a lot of companies that, we've been speaking to for 18 months now that still haven't run a secondary. And where we've had to go through multiple hoops of, misinformed opinions that they had about what secondaries entail.
Understood. Are there any other challenges that you can foresee in the short or midterm, and how are you working towards address them?
Yeah, so as I mentioned, the biggest challenge is really this this gap in pricing expectations. I think is really the biggest problem still. So companies really being anchored to the last price at which they raised, and on the other end, investors looking at public comparables and saying like, this is completely unjustifiable now. That's definitely still the biggest hurdle to increasing transaction volume in the secondary space. And then the second one is probably employees not necessarily understanding all the subtleties of what equity means and still undervaluing it quite a bit. And so not always creating the internal pressure within the companies for this to become the priority. Because, until you have a lot of employees complaining about the fact that they can't sell, the company is going to procrastinate a bit on setting up this kind of program.
But I hope, like at some point this podcast becomes a bit more popular.
Yeah,
Have
sure.
some people kind of like listening and do that. So I think just to reaching sort of like the final two questions over here, what are you most excited about in terms of, like where Semper is going on a personal level?
I mean, on a personal level, I think the coolest thing of what we do is that, when it works, you end up sending a check, which is going to be the most meaningful check that these people ever received. And it's going to be the materialization of huge amounts of work and blood and sweat and tears. And that's a very, very special feeling to be able to play a small part in that. And then a kind of related thing about that is that, we both Balthazar and I spend a lot of time helping early stage founders start companies. And one of the things that we're convinced of is that if you have more people who are able to benefit from the value of their equity and sell it earlier, you're going to have a lot more people starting companies. Because, if you spent a couple of years at Revolut and you learned the ropes and you were able to take some money off the table to, de-risk a bit or potentially have a bit of a safety cushion, then you're a lot more likely to jump ship and start your own business. And that's an incredible flywheel for the entrepreneurial ecosystem, is having people who've learned the ropes at a successful company and then decide to take those learnings and tackle a new problem. And the faster we get, talent, to become as liquid as the capital, then the more businesses we're going to have, and the more jobs are going to be created, and the more problems are going to be solved. And that's super, super exciting for us.
And I think like if you just take the recent trend where more and more top talent wants to now work on like some really urgent problems that need to be solving, like things such as climate, or people now looking into deep tech and kind of like trying to solve for a lot of different scenarios. I think unlocking that talent, that aspect that you mentioned, where like these people are now, they have the funds at their hand to go and try their hand at building these like ventures that could help save the world in a way. I think like that's also something that like I personally am excited about, drawing off what you said. So just to close this off, how like building a company is quite a stressful engagement. How do you manage your own stress and mental wellness? And do you have any tips for other people who might be listening?
It's a good question. I mean, I think you have to embrace that there's going to be some irreducible amount of stress.
Yeah.
I do think, I mean, so I'd say there's an irreducible amount of stress for sure. And, part of the reason that you're so well compensated if things go well is that this job is just very hard. And like, there's some aspect of this job being very hard that you're not going to be able to get rid of. What I would say is that some people misinterpret that into you should not take care of yourself at all. And I was a culprit of that at some stages in both previous companies and as part of Semper. And I've seen a lot of friends kind of completely disregard their health, like not sleep enough, not do any exercise. And that ends up coming at you in pretty nasty ways. You get sick, your productivity falls. And so I think that's probably the most important thing, is that people neglect their sleep and their exercise. What remains true is that in the early days, I think it changes a lot when you have a bit of a more established machine and you've completely nailed your product market fit. But in the early days, it's really hard to have it all. Like you can't sleep 8 hours, exercise for an hour, spend 3-4 hours with your friends and family, and work as much as you probably need to get there. And so it's, the people that I see burning out are the people who try to do everything, because typically the first thing that they end up neglecting is their health, meaning their sleep and taking the time to exercise and eat properly. And then you end up doing none of the rest really well, because you're always tired when you're working. You're always tired when you're with your friends. So I think you just need to understand what your priorities are. And the one that you shouldn't really compromise on is your health. And so now I'm just very strict about it. Like I know the amount of hours that I need to sleep in order to be productive the next day. I know that, if there's 2 days in a row where I don't exercise, I'm going to start feeling completely restless and my mind isn't going to work well. And so I'm just very strict about my calendar on those things. And then, I also know that I can't say yes to every event that I'm invited to. But I've kind of made my peace with that. And I think at the beginning it's hard because, you think you're different from the others and you're the exception. Again, that person who's going to survive in the plane crash, like the rules that apply to everyone don't apply to me. But I think once you make your peace with that, it becomes a lot more manageable.
Got it. Understand. So, well, Matthias, thank you. This has been very enlightening. Like, I really, again, thank you for being the first guest. How can people reach you? And also, where would be the best place for them to go and learn more about Semper?
So Semper, the easiest place to go is on our website, meetsemper.com. And then reaching me either on Twitter, my handle is Pastor MHM, or via email. I reply to pretty much all my emails, and my email is Mathias, Mathias, at meetsemper.com. So happy to be reached out on either of those.
Cool. We'll drop those into the links section of this podcast. So we're going to wrap this up now. Thank you again. Thank you very much,
Yusuf.
Mathias.
Thanks. Good luck with the podcast, and enjoy your time at Oxford.
Thank you for tuning into OxIgnite. Please reach out to Yusuf, Raza, or Michael Hutson on LinkedIn if you are an entrepreneur with ties to Oxford and want to create more awareness about your venture, or if you are an investor interested in investing in Oxford-linked startups, or if you are a brand that wants to sponsor an episode of the OxIgnite podcast. If you like this podcast, please help us spread the word to your network. We would also welcome any donations to help us scale this podcast. You can donate at buymeacoffee.com/OxIgnite, OXIGNITE.